Welcome, everyone, to MoneyShow's Accredited Investors Virtual Expo and our next presentation. My name is Natasha, and I'm your host. I am pleased to introduce Murray Gunn, who is the head of global research at Elliott Wave International and a lead contributor on deflation.com. Today, Mr. Gunn will be discussing an investment roadmap for 2022. There will be time at the end of the presentation for questions. Please type your questions in the chat, and I will present them for you. Thank you for joining us, Murray. We look forward to your presentation.
Thank you very much, Natasha, and good day, everyone. And thank you very much for attending this presentation. I feel strangely honoured to be giving a presentation on the 34th anniversary of the day of the 1987 crash. So for those of you who were around then, hopefully this will be a much more pleasant experience than that, unless, of course, you were short of the market on that day. So the title of the presentation is Investment Roadmap for 2022, and we've got a lot to get through. So I think we'll just crack straight on. And what I thought was, since the world is getting back to normal these days, and we're all beginning to fly around the world, then I thought we could jump on a 747 and take a trip around the planet, a look at the global economy, the global markets, a global macro view from 30,000 feet, so a wide-angled sort of view. But before I do that, I'd like to just remind you of our analysis process and what it's based on. So our analysis process is based on the Elliott Wave principle, and the Elliott Wave principle was discovered by a man called Ralph Elliott in the 1930s. What he discovered by looking at the stock market was that markets move in patterns, and he called them waves. What he found was that there was a limited number of patterns and that they repeated at every time frame. Not only that, but the waves that he found that these waves were related in terms of natural mathematics based on the golden ratio of 1.618. So this diagram here shows a typical Elliott wave, and you can see how the bigger waves are related to the smaller waves and vice versa. And so if you want to know a lot more about the Elliott wave principle, there's all you really need to know is on the our website, elliottwave.com. And if you can hang on to the end of the presentation, I'll be giving you a link to the seminal textbook on the subject, and this will be yours for free, a free link to a free book on elliottwave.com. So please hang on to the end of the presentation for that. Now, before Ralph Elliott came along, there was a man called Charles Dow, who you've no doubt heard about. He founded the Wall Street Journal and obviously founded the Dow Averages. But he was a journalist, and he was very interested in the market and economic cycles. And his writings became known, after he died, his writings became known as what was called Dow Theory. So then along came Ralph Elliott, and after he made his discovery of the Elliott Wave principle, what he realized was that what he discovered had a forecasting element to it. And it was a real advantage, a real add-on to Dow Theory. And so it's this forecasting element of the Elliott Wave principle which makes it actually so powerful. Another big element of the cycle analysis, Dow Theory, the Elliott Wave principle, is looking at credit conditions. And that's what we like to do a lot where we are concerned. So let's have a look at the credit and sentiment backdrop that's in place today. So this chart here really shows the sort of the basis of our underlying thesis at the moment. This shows the Japanese private sector debt as a percentage of GDP from the 1980s, or during the 1980s. And you can see this is going up pretty much in a straight line as the social mood, as we like to call it, was propelling the Nikkei forward. The Japanese society, the Japanese economy was in a major bull market, and private sector debt as a percentage of GDP was up at around 210%. Then, of course, the Nikkei topped out because social mood turned negative. And after that, of course, you had this period of massive debt deflation, which lasted a number of decades in Japan. And this is what we fear is happening now in the West. This shows the private sector debt as a percentage of GDP in at the moment for the 2020 figures from the OECD. And you can see how many of the countries, these developed economies, are above 200% of private debt to GDP. And it's the private debt really that we're interested in more than anything else, because as the Japanese example shows, although private debt was deflating, public debt was inflating at that stage as well. It was a massive increase in public debt, but yet they still had this problem of a lackluster economy. So at the moment, we can see the US is at 242, the UK is at 205. A lot of the European economies are up in the 270s, 280s. And also look at Japan. Japan's back at 238, higher than it was at the end of 1989. So, that's something to consider. And so why are people, not worried about debt? Well, debt really is only a problem when mood, as we like to call it, turns into a negative trend. When social mood is in a positive trend, debt really isn't an issue. And this chart here shows an indication of why it's not really a problem at the moment, because this is called the Financial Stress Index from the St. Louis Fed. And it's based on credit spreads, stock markets, volatility measures like the VIX. And you can see that during the 1990s, it was held at this sort of level here. Then in 04, 05, during the major bubble that existed then in real estate and stocks, it got really, really relaxed. It ended up in the great financial crisis, of course. And you can see now where we are here, we're in the most relaxed state that we've been since 07 in terms of this financial stress index. So people aren't worried at all. And there's a reason for that. The reason why people aren't worried at all is because of this, really. And this has been repeated around the world, but this shows the US real money supply annual change. So it's the M2 money stock adjusted for consumer price inflation. And you can see from the 1960s, we went through cycles of, it would go up, it would inflate by maybe 8%, 10%, 10%, etc. back in the mid 1980s, but nothing really above 10%. Until that is, we get to World War C. Obviously, the COVID pandemic caused a lot of panic among central banks, and what they should do to try and stem the lockdowns of the economy. And you can see that obviously money supply went ballistic, as we all know. Now, interestingly, what's happening now, of course, is that it's beginning to deflate. This is the true definition of deflation, which is an increase. Inflation is an increase of an expansion of money and credit, and deflation is a decrease in money and credit in the economy. Nothing really to do with consumer prices. So this is quite interesting from our point of view. Part of this reduction here is, or this deceleration, is because of what's happened to consumer prices in this measurement. But it's an indication, as we'll see later on, of what is actually happening within the sort of interest rate world. And this is the result, really, of what's been happening in the money supply environment. This is quite an incredible chart. This shows the overnight, what we call reverse repurchase agreements or reverse repos. And what this is a measurement of the cash, the sort of excess cash that banks in the US don't want, they can't use, and they give that to the Fed in swaps for T-bills and bonds, which are then reversed the next day. And it gives the banks a place to park their cash, which they don't want or can't use. And as you can see, in the last few years, it's had the odd blip or two, but nothing quite like what's happened in the last year or so. And this is quite incredible, over $1.2 trillion of cash that's just unused. And this is a real indication that obviously the US, especially the US money supply, has just gone too far. There's a cash glut at the moment. And so what does that mean? Well, that money kind of goes into the financial markets, of course, and this shows the margin debt of the US stock market. We can see back here the technology, media and telecoms bubble, or the dot-com bubble, as some people like to call it. That's the level we got to at that stage. In 06, we got in the real estate financial bubble, we got to slightly above that. But look at what we've done in the last 10 years in terms of this easy money era. Of course, this is what we call really the everything bubble, whether it's Bitcoin or real estate, whatever you want to talk about. Everything seems to be in a bubble at the moment. So that's from the sort of debt side, but it's interesting just recently what's been happening in consumer sentiment. And this is a chart of the University of Michigan consumer sentiment, and people are beginning to sort of look at this just now because of the fact that it can, some people believe, especially the sort of conventional analysts like economists, they believe that it can actually lead into recession. And you can see in the past 20 years or so, 30 years or so, it has actually led into recessions. And so what's interesting now is that it peaked out back in 2020 and it's still decelerating consumer sentiment. So you get this amazing dichotomy at the moment where the consumers don't seem to be too joyous in terms of consumer sentiment, but the financial markets are on in a manic stage. So that's what the debt and leverage conditions, the sentiment conditions are saying at the moment. What really is the sort of nuts and bolts of what we're looking at is what do Elliott waves point to? Because as I say, the debt conditions are really, they're in place, but they're only a problem. They're not a problem until social mood and the mood of the market sentiment really turns down. So is that happening? Well, I'm going to start, rather than start with the stock markets, as most people would usually do, I'm starting with the most important market in the world, which is the bond market. I think it was an advisor to Bill Clinton, an economic advisor to Bill Clinton back in the 90s, who said that when he died, he thought he wanted to come back as a good baseball player or the Pope. But in actual fact, he decided he wanted to come back as the bond market, because the bond market can intimidate everyone. And this is really the most important market in the world. This is what we think of the bond market at the moment. This is the Bloomberg Barclays Global Aggregate Index Yield. So this lumps all bonds, whether it's treasuries, agencies, corporate bonds, emerging market bonds, everything goes into this calculation of this index. And we can gauge some Elliott wave patterns from it. So we think that last year, in fact, back in 2020, that the market completed its reduction in its bull market in price, if you like, its decline in yield, which has lasted for a number of decades. And since then, we're starting to trace out an upward movement in yield. In terms of yield, that means a downward movement in bond prices. So it's really like a bond bear market has been getting underway. And this is important because especially what's been happening in the last few months, you can see that the US Treasury 2-year yield, which has been basically nothing since the pandemic started. Back in sort of February, March time, it started to peak up, to perk up, and it started to actually bit of a trending up. And recently it's got the headlines, of course, because it's just made a bit of an extra move up. But this is the point that we make at Elliott Wave International, because obviously the talk now is of the Fed. Are they going to tighten? Will they tighten policy? But the central banks are always led by what the actual markets are doing. So the free markets are leading the Fed into raising interest rates. And this is just something I was looking at today, just as an example of that. This shows another economy where people are talking about, the central banks are beginning to talk about higher interest rates, therefore the bond markets are selling off or going to higher yields. That's the wrong way around. The bond markets go to higher yields and then the central banks raise rates. And you can see here how the movement in the 2-year yield in the gilt, the UK gilt, has actually led the Bank of England over the last number of years to change rates. So this movement here is showing that the Bank of England should be hiking rates. Now, what about the German? But this chart is a good example of other bond markets, other bond yields. You can see this down channel in the Bund over the last decade or so. It broke the down channel, and often when that happens, the market will come back and often what we call kiss it goodbye. And you can see it did so here in the Bund. So this is definitely what we'd say is it's kind of Auf Wiedersehen to German Bund yields in terms of the fact that they'll probably be moving above zero at some point. In terms of credit spreads, this is where the real interest lies, because there's a lot of correlation between credit spreads, what the corporate bond markets are doing, and the stock markets. And you can see here, this is essentially the junkiest of junk bonds, the CCC and lower rated yield spread to US Treasuries. We can see here during the dot-com bust how it spiked up, showing that yields were much higher on corporate debt on junk bonds than they were on US Treasuries. And when they're tight, that means that the markets are very, very relaxed. And you can see here that this is the tightest spreads really we've been at since, again, just before the great financial crisis, and well below the average. So it looks like the credit cycle is potentially beginning to turn. We should pay attention to what's happening in China as well. This shows the Chinese junk bonds in terms of an ETF, and US junk bonds, HYG, in terms of an ETF. And they were following each other quite nicely up until this year. And then, of course, we've had this happen. So, you could turn around and say, okay, well, China's just on its own. It's an example. It will just sort itself out. But, the world was connected. Obviously, this is a sign that perhaps globalization is beginning to fall apart a little bit. But we wouldn't dismiss the sort of after effects of what's been happening in the Chinese corporate bond market in terms of what could happen in the West. And just from a purely Elliott Wave point of view on the bond market, this shows the junk bond yield spread on a short-term basis, really just from July. This was the narrowest spread since 2007, and you can see a clear five-wave movement up from the low here. And what that means is once we see a five-wave movement higher off a significant low point, followed by a sideways movement, it's quite highly probable that there's going to be another movement in that direction. Whether that turns out to be a full-on trend or not, at least for that next movement, it's highly probable that there'll be another move up in this case. So another widening of credit spreads, which is something to think about before the end of the year. Okay, so let's move on to what we think of stock markets, and this is the Vanguard Total World Stock Index ETF, based on essentially the global stock market index. And we can see here that the way we're labeling this market is that wave 5 of 5 of 5 has basically ended, and we should now be expecting a downturn. What gives us what adds weight to this sort of probability is the fact that this pattern here from 2017 to 2020 is what we call, in Elliott Wave terms, an expanded flat pattern. And an expanded flat pattern very often happens in a fourth wave. And especially, given the global stock market index has been rallying for a number of years before 2017. So this gives us, great confidence that this is a fourth wave. And so therefore, since March 2020, it's been in a fifth wave, and we think that's over now. Another reason for that is some of you might be fans of Japanese candlestick charting, and if you look at in terms of the Japanese candlesticks, we had what we call a bearish engulfing candlestick using a monthly time frame on the global stock market. And that's quite a rare pattern to see. So that certainly gives us added weight to the Elliott Wave analysis that the global stock market is topping out. And also this is quite incredible, this statistic. This shows the annual flows into global equity funds, data from the Bank of America. And you can see it's absolutely exploded this year. In fact, there's been more inflows this year into, and of course the year isn't finished, more inflows this year into global equity funds than there has been over the last 20 years combined. Now, you might think that's a good thing. And if we were near the start of a trend or just coming into the middle of the trend, you'd say that's you know, fine. That's maybe a point. But after a decade plus of a rising global stock market, and we see these sort of inflows, it's a sign of overexuberance, very much a sign of overexuberance and very, very excessive bullish sentiment. In terms of the US stock market, this is the chart showing the long-term wave count, Elliott wave count of the Dow Jones Industrial Average. And we can see here, we think super cycle wave 4 finished in 1932. Since then, we've seen a 5-wave cycle move higher, and we're finishing it now at this point. Now, what's interesting about last year was that the last year was the first outside year. This is quite like an engulfing pattern in candlesticks. It's a little bit different, but it's when the high and the low engulf the previous high and low. And not only that, it actually engulfed the previous 3 years worth of data. So this is a really significant pattern to think about here. In fact, if you're into your candlesticks, you'll see that this is what we would call a hanging man candlestick from last year. So if the market closes down this year, and okay, we've only got another few weeks to go before the end of the year, it would be highly, highly significant, but significant nonetheless, especially from a wave count point of view. Now, this shows the real, what we call the real US stock market. And this is the Wilshire 5000 divided by the Fed's balance sheet. In other words, the stock market adjusted for the increase in the money supply that the Fed has been printing. And you can see how vastly different things would have been had the Fed not intervened. Now, my fellow countryman from Scotland, Billy Connolly, now a Florida resident, he has a famous song which has a line, if it wasn't for your wellies, which are galoshes, if it wasn't for your wellies, where would you be? And I often think about that song when I look at this chart, because if I was thinking, if it wasn't for the Fed, where would we be? So this is very much the sort of Fed illusion that's been played out in the market over the last decade. Another reason to be nervous of the stock markets at the moment is because of Dow Theory. And so one of the major aspects of Dow Theory is that the industrial average and the transportation average should confirm each other if it's a healthy market. And we can see here back in the run up to the crash in 2020, there was a huge, what we call a non-confirmation going on. So the industrial average was making new highs, but the transportation average wasn't. And this is happening again now. So this is another reason to think that you know, all might not be rosy in the stock market at the moment. Another reason, which is quite fascinating, is looking at time cycles. And 2021 could be a year of a significant high point in stock markets, given the fact that it's in terms of Fibonacci numbers, which is a huge part of the Elliott Wave principle in natural mathematics. It's 89 years, these are all Fibonacci numbers, 89 years, 2021 is, since the 1932 low. It's 55 years since the 1966 high, which was cycle degree wave 3 top in our Elliott Wave analysis. As I mentioned at the start, it's 34 years since the 1987 crash. It's 21 years since the 2000 top of the TMT bubble. And it's 13 years since the great financial crisis of 2008. So 2021 in terms of cycles has an amazing element to it. Not only that, it's also 233 years since 1788, which is also 233 is a Fibonacci number, which was the ratification of the Constitution of the US, which is essentially the beginning of the USA. So by all measures, 2021 is turning out, or should be, a very significant year, has the potential to be at least. Okay, so that's the US and the global markets, but let's look at a couple of other ones just briefly. This is the Chinese market, the Shanghai Composite. And we think this is in a triangle pattern. So eventually very bullish. But look, the China market has topped out in 2007. If you ever wonder why China is becoming a little bit more negative in terms of mood at the moment, although people might think that way, it's because it's been driven, the stock market's been driven, society's been driven by that sort of negative mood since 2007. One of the reasons why we think this really is a triangle is because wave C here turned out to be almost exactly 0.618 of wave A, which is your Fibonacci ratio. And that often happens in triangles. So we're quite confident that this is a good pattern. It looks like it's got a bit more to go maybe next year in China on the upside. In the European markets, again, a pattern which gives us confidence of a fourth wave is a triangular pattern. And we can see here in the DAX, this was a triangle, and we're just tracing out the last vestiges of wave 5 now. Another reason why we think this is a fifth wave is because the momentum is weaker. We're having a bit of bearish divergence with regard to the relative strength index in terms of the fifth wave in the German market. From a bit of a shorter term point of view, though, now the DAX index is different from other indices. It's a total return index. If we take that total return out of the DAX and just look at it on a price basis, as we do here in the Dow Jones Germany Stock Index, what's really interesting happening at the moment is this area of tops back here in 2017 and 2018, they're starting to act as support for the market, which we have to say is on the face of it is bullish, at least in the short term. So, but this is what we're looking at very much for next year. If this starts to break down, then all this thesis that I'm talking about will really start to come to fruition. Okay, just a couple more slides, a few more slides left before we get some time for questions. So that's the stock markets and the bond markets. What about the currency markets? Well, this is our outlook for the US dollar index. And in terms of currencies, how they move in Elliott waves, they move in broad patterns of three waves. And within those three wave movements, you do have obviously a lot of five wave movements as well. For instance, C waves are five wave affairs. So what we think has been happening in the dollar index is that we had this move down here in wave A, a correction higher, A, B, C for wave B, and we're just starting to get going in wave C down. And if we're correct, if this wave count is correct, this should trace out a five wave pattern, which should take the US dollar index quite significantly lower. And the euro dollar is really just the sort of inverse of the US dollar index, because the dollar index is quite heavily weighted to Western European currencies. And so of course, the wave counts look broadly similar. So we think with the euro dollar, it's just completing a wave 2 correction roundabout where we are at the moment. And it's the next significant movement in the euro dollar should be for an appreciating euro and a weaker dollar. Maybe the currency that a lot of people want to know about more than anything else at the moment is Bitcoin. This is our wave count for Bitcoin from the inception. So we can see that we're counting it as essentially five waves up, just coming into the fifth wave in Bitcoin since its inception back in 2010. And what that means is that once this is complete, once this fifth wave is complete, there should be a very significant top forming. The jury's still out as to whether that's here or whether it's a little bit further up, but I would encourage you to follow elliottwave.com to have the short-term updates on that one for next year. And lastly, the last couple of slides on commodity markets. I actually showed this chart back in May, and it shows the commodities relative to the stock market. So the global price of all commodities divided by the Wilshire 5000 index, and you can see how cheap commodities were as we came into 2020. And of course, since then, the commodities indices have had a big rally, as we all know. So we're counting this as the bear markets since 2008 was completed in 2020, And since then, the movement up is probably just wave one of a new bull market in commodities. Now, the thing to pay attention here is that if this is wave one, second wave retracements in Elliott waves can be very sharp and very deep. So this is what we are focusing our minds at the moment, is on the commodity markets, is whether we do get that sharp and deep retracement. So the conclusion is really, is the bond bear market underway, yields higher, should be we're looking at our thesis for a global equity slump is very probable, with the US underperforming Europe and China. We're looking for dollar weakness, and we think we're in a new commodity bull market, but beware of the sharp retracement. Okay, and finally, I promised you the link to a free book, and so here it is. If you type this link into your browser, you'll come up with a link to be able to access Frost & Prechter's Elliott Wave Principle, the seminal book on the subject, written in 1978. So please take a note of that link and get the free book. That's it. I think I'm on time, Natasha. So thank you very much, everyone. And has anyone got any questions?
Yes, thank you. You have a couple of good questions here. The first one is, hello, wonderful presentation. Another guest and prominent Elliott Wave analyst says the SPX is heading to 5,500 to 6,000 range within the next couple of years before going bearish. How do you reconcile your very different views using the same analysis?
Well, it's a good question, and there are what we do at Elliott Wave International is we encourage analysts to have different wave counts or approach things from a unique point of view, because once you get into Elliott Wave Principle, you realize that one of the major advantages of the Elliott Wave Principle is what Elliott called alternate wave counts, and what that means is at any one time there are maybe two or maybe even three different wave counts which are possible. The job of the analyst is to take into account sentiment indicators, volume indicators, everything else that's related to the Elliott Wave Principle in order to work out really what's the most probable wave count. So that's where the difference comes. Some people look at different things in terms of what the conclusion they come to is what's the most probable. Our basis is we think at the moment the most probable count is that we're topping out now. But yes, an alternate count is for more bullishness.
And that same attendee says, thank you for your time and answering my questions. And here's another question. Using Elliott Wave, how do you know the V of V, so it's a lowercase v of capital V of 5 top is occurring now in the US indices and not sometime in the future? Did I read that correctly? I could read it again if you want.
No, that's okay. Well, I'm a bit confused by the B of B.
V as in Victor.
Oh, V, right,
V.
Sorry, yes. Well, yeah, it's related to the previous question, I think. Given our experience of analyzing markets based on the Elliott Wave analysis over multiple decades, given what's been happening in the debt markets, the sentiment that's involved in the markets at the moment, the highly bullish sentiment, but really it gets down to the overall pattern, because the Elliott Wave is at the end of the day an objective analysis, and we can't make up the numbers, we can't make up what the waves are telling us. But based on our experience, we think that the top is on us at the moment. But as I said in the previous question, there are always alternate wave counts, and we pay attention to that. So if levels are broken in terms of a new high is being made, then that will increase the probability that the alternate wave count is correct. And our analysis changes, is updated, on an ongoing basis. So I would encourage you to maybe look at elliottwave.com and keep up with the analysis.
Okay, thank you. There's a little clarification from the question. It says V meaning 5. So let me read that back. How do you know the 5 of or the V of 5 top is occurring? So same answer. Is that correct?
absolutely
Yes.
correct. Yes. Yeah.
Okay. And then last question here. Indian stock market is not showing any weakness. Any comment?
Well, our Elliott Wave International Asia Pacific analyst is certainly bullish of the Indian stock market on a longer term basis. And so I would encourage you to look at elliottwave.com to see what the short term views are there.
Okay. And final question, what asset classes do you recommend now? Can that also be found at elliottwave.com?
Well, if it comes to fruition that we do have this slump in the stock markets, it depends where you're coming from. I mean, if you're a relative value manager, then like I said, if we do have a downturn in the stock markets, there'll still be a case for a bull market in some of the Asian markets, and China certainly has potential to be moving up next year. So from a relative value point of view, there could be plays there, but from an absolute return point of view, if that's your game, then certainly if the major developed stock markets turn down and yields are going higher, then cash is obviously the asset class. And within that, something like a floating rate note, if yields are starting to go higher in the short end of the bond market, then we think that floating rate notes might make a comeback.
Thank you. That is very helpful information. We are running out of time. If it's okay, I will share my screen and talk a little bit quickly about our upcoming. Sorry. Sorry. Okay, that's not working. Oh, it's me. Hold on. Stop. Okay, actually, I should just conclude and say thank you for everyone who came today to our highly successful events. We appreciate your feedback. If you have any comments or questions, please send them to us at MoneyShow. We read them all and it helps us to refine our process. Also, we want to mention that our next live presentation will be at the Traders Expo in February in Las Vegas. Please join us there. And I want to thank you again, Murray, for all your insights, and thank you to the attendees. We appreciate you all and have a great day.
Thank you.
Thank you. Ooh.